Okay guys, so we're going to start on chapter 14 here, mortgages. So in your textbook, this is going to be on page 311. So in this chapter, we're going to talk all about mortgages and financing, the different types of loans, how a bank determines how much money they'll lend you, and a whole lot of other things about financing as well. So just to start off with here in this chapter, the first paragraph on page 311, you'll see the word mortgage bolded. I think this is an important word to highlight, and the reason I say that is because most people come into real estate class just not knowing what the word mortgage means, and frankly, after you guys graduate real estate class, most people go back to using it the wrong way too. Some people will say, or most people will say, I'm buying a house and I'm taking out a mortgage. Well, you're not actually. You're buying a house and you're taking out a loan. In return, you as the borrower, you're signing mortgage documents over to the bank. When you sign those mortgage documents over to the bank, you're telling the bank, thank you for giving me, let's say, $500,000 to buy this home. Now, in return, I'm going to sign these mortgage documents, so if I stop paying you back, you then can foreclose on my house. You can sell my house to get your money back. So what a mortgage is, it's really a document. It's a document the borrower signs over the lender that says, if I stop making my payments to you, you can take my house, you can foreclose on it, and you can sell it to pay yourself back. So the book definition of mortgage, I would highlight in the first paragraph here on page 311, and what it says, it's a grant of an interest in real or personal property with a provision for the release of that property upon repayment of debt in full. So if on the test they ask you about the mortgagor and the mortgagee, you guys know from in class, I always tell you if a word ends in OR, we say it gives the base of word, and if a word ends in double E, we say it receives the base of word. So the mortgagor, the party who gives the mortgage, is actually the borrower. The borrower gives a mortgage to the bank because the borrower is the one giving up an interest in their real or personal property. The bank is the party who receives that. The bank is the mortgagee. The bank receives the mortgage. Now, I always tell people for test purposes, maybe a simple, easy way to remember this is to use a stupid little rhyme that I always tell people to use. And that rhyme is the mortgagee is not me. If the mortgagee is not me, then it's got to be who? It's got to be the lender then in that circumstance. So maybe that little rhyme helps you. The mortgagee is not me. So if the mortgagee is not me, then the mortgagee in that circumstance would be the lender, as an example. And also here on the left side of 311, you'll see mortgagor or mortgagee highlighted. We just spoke about those, but you see promissory note here as well. Now, a promissory note is something that you are going to sign along with when you take out a loan from a bank. The bank's going to have you sign this promissory note. The reason they make you sign this promissory note is two-part. Number one, it's the primary evidence of the loan. By me signing that, it's basically evidence that I've taken out this loan. So number one, it's the primary evidence of the loan. And number two, it creates a personal obligation for the borrower to repay the debt. So in this circumstance, if the bank has to foreclose on you, and they foreclose, and their sale proceeds are $450, and you owe $500, they can come after you personally for that $50,000 difference because you signed that promissory note. Now, if they were to come after you for that $50,000 difference, in the example that I gave, they foreclose and the sale proceeds are $450, but you owe $500, they can come after you for that $50,000 difference by filing for what we call a deficiency judgment, and that's bolded here towards the bottom left of 311 as well. So this deficiency judgment basically is the lender saying to you, you're deficient on what you owe us by $50,000. So we are going to come after you for that $50,000 by filing for what we call a deficiency judgment. So if they were to ask you, if the sale proceeds fall short of what is owed on the home after a foreclosure sale, what can the lender file to go back collecting the difference? And that's the deficiency judgment. You're deficient on your debt by that $50,000 amount. And then towards the bottom left here, right below the paragraph where deficiency judgment is bolded, you'll see something that says the amount of the mortgagee's loan commitment. Now, to keep it simple on you, they might ask you, how does a bank determine how much money they're going to lend you on a loan? And it's really simple. They just take the lower of the appraised value and sales price. So if they were to ask you, how does a bank go about determining how much money they will lend you on a home? It's simply based off the lower of the appraised value and sales price. So if the bank appraises your home for, let's say, $400,000, and I submitted a contract to purchase it at $410,000, and the buyer and seller agreed on $410,000, well, the bank says, listen, we really don't care what your bid was. We really don't care what was accepted. What we care is what this place is worth, because for all we know, you could have submitted a bid for $800,000 on a house worth $400,000. Doesn't mean we're going to lend you based off an 800 purchase price, because if we give you, let's say, 650 on an 800 purchase price, and the thing's worth, let's say 400, and you get struck by lightning tomorrow and die, and we have to foreclose, we're going to lose our shirts. We're going to lose a ton of money. So the bank, what they really care about and why they order the appraisal is to make sure they can substantiate the value you're buying the home for. So if they ask you on the test, how does a bank determine value? A bank determines value based off the lower of the appraised value and sales price. And kind of stemming off that is where we get into things like loan-to-value ratios. So a loan-to-value ratio is just what it sounds like. It's loan to value. So if my loan amount was $400 and the value of the home was $500, the loan-to-value ratio there is 80%, as an example. Now, where they could try to confuse you here on the test is they could say, you're taking out a loan for $400, your offer was accepted at $500, the appraisal came in at $520. What is the loan-to-value ratio? In this case, you would still use the $500 as the value. You always use the lower of the appraised value and sales price. And in my example, the value value that the appraiser said was $520. Your offer that was accepted was $500. The lower of the two is $500. Whichever one of those numbers is lower is the one that you ultimately go with. And then on the right side here of page 311, towards the top right, you'll see the first full paragraph there. It says there are two basic theories regarding the ownership position. So New Jersey is what we call a lien theory state. What a lien theory state means is that when I take out a loan from a bank, the bank places a lien on my home. So again, when I take out a loan on a home, the bank will place a lien on my home. When I take out that loan, the bank doesn't just say, I'm going to hold on to your deed until you pay me back. No, the bank places a lien on my home. And that lien gets removed once I pay off my loan balance in full. So New Jersey is what we call a lien theory state. You take out a loan from a bank, they place a lien on your home. And the paragraph below that talks about a deed of trust or a trust deed. Now, a trust deed is an alternative to a mortgage. And the way that this here works is, let's say I'm a seller. I'm trying to sell my place for $700,000. I'm getting no bites at all on it. Nobody's willing to buy it for $700,000. But luckily enough for me, a guy approaches me and he says, I'll buy this off you for $700, and I'll give you $250 up front. But I need you to hold a note for me for $450,000, and I'll pay you back that $450,000 over 15 years at 5% interest. Now, I, as a seller, naturally say, if you're willing to put down $250, why can't you just get a regular mortgage for $450? And the guy then says to me, well, I had a foreclosure last year, and no bank's willing to lend me money right now, so I need some form of seller financing. Now, I, as a seller, say, do I look stupid? You just had a foreclosure last year. Why would I lend you money? And he says, well, don't worry about it. We're going to set it up as a trust deed. And the way we set that up is when you sell the property to me, I'll give you $250 up front, and then I'll pay you back the rest of the $450 over 15 years at 5% interest. But rather than you, Mr. and Mrs. Seller, give me the deed, you'll give that to a neutral third-party trustee who will hold on to that in trust. So that, in the case of default, if I stop making my loan payments, that trustee gives the deed right back to you, and we avoid that whole prolonged foreclosure process that could take years in some cases. So that's how a trust deed works. It's an alternative to a mortgage, where basically the deed, rather than being given to the buyer, is given to a neutral third-party trustee and held on to in trust. Then towards the bottom right of 311, talks about this term here, hypothecate. So the term hypothecate means to pledge property as collateral for a loan. Now, hypothecate could be used to describe pledging a car as collateral for a car loan, to pledge a house as collateral for a home loan. Just in general, to pledge property as collateral for a loan, we broadly define as hypothecate. So the term hypothecate means to pledge property as collateral for a loan. Let's turn the page here. Let's go to 312. 312, towards the bottom left there, you'll see a bolded term, junior mortgage. So a junior mortgage, they might ask you on the test, what's the best description, and then sometimes what's an example. The best description of a junior mortgage is any mortgage that is subordinate to another. Now, when we say any mortgage that's subordinate to another, it really just means any mortgage that's not the first one. So again, the best description of a junior mortgage is any mortgage that is subordinate to another. A good example of that would be a second mortgage, a third mortgage, a fourth mortgage. Really, a good example is any mortgage that is not the first one. So for a junior mortgage, the best description, any mortgage that is subordinate to another. A good example of that is any mortgage that's not the first one. And as we get to the right side here of 312, we start getting into the different clauses that you might find in a loan. And the first one listed here is the acceleration clause. Now, if you guys hear the word accelerate in real life, you know that means to speed up, right? So the acceleration clause, what it states is that upon the happening of a certain event, the lender may speed up the payments and call the entire balance due. Now, when we say upon the happening of a certain event, what's one example? One example would be if I stop making my loan payments. If I stop making my loan payments, the bank can reach out to me and say, hey, you stop making your loan payments, we're going to initiate the foreclosure process. Your entire balance is now due in 2 months. So that's one example where it could be initiated. The most common example, though, is a form of the acceleration clause listed here called the alienation clause. The alienation clause, first and foremost, if we know the term alienate, it means convey or transfer property. So the alienation clause states that when you do convey or transfer your property, you must pay off your entire loan balance in full. In other words, upon the happening of a certain event, in this case selling your home, you must pay off your entire balance in full. So one form of the acceleration clause is this clause here called the alienation clause, which states again, when you convey or transfer your property, you must pay off your entire balance in full. Now, another word they can use for the alienation clause is due on sale clause, which really essentially means due on the sale of your home, you must do what with your loan? You must pay it off in full. And then below that, number 2 here talks about the defeasance clause. And what we get into here is when is the lender's interest defeated in the property? And the lender's interest would be defeated in the property once you've paid off your loan balance in full. So once you've paid off your loan balance in full, the defeasance clause kicks in at that point in time. Now, when the defeasance clause kicks in, what you receive is what we call a satisfaction piece from the lender. So the lender more or less says, congratulations, you've paid off your loan balance in full. We no longer have an interest in your property. So the clause that defeats the lender's interest in the property is the defeasance clause. The document you get along with that called a satisfaction piece. And number 3 here, subordination clause. This is something that's extremely rare, but what a subordination clause would be is if you allow a subsequently acquired lien holder to jump you as a primary lien holder in order of recording, you have granted that secondary lien holder a subordination clause. Now, it's really rare because lien holders are paid out based on the order of recording, so a primary lien holder would never want to sign that because they don't want to give up their priority position to a secondary lien holder here. So, but that's what the subordination clause does. It allows a subsequently acquired lien holder to take legal priority. And then 4 and 5 here, covenant to pay taxes. Basically a covenant in the mortgage that says you'll pay your property taxes. Insurance clause, you'll keep insurance on the property. And number 6, good repair clause. That's a clause that basically says, the property is going to be kept in good shape. So again, you want to make sure your property is kept in good shape because if it's not, you could certainly run into some issues there. Namely, the bank could foreclose on you. So it's really rare, but if you have a number of quality of living summons issued by the town because your grass is 10 feet high, your windows are broken, your gutters are falling off, your siding's falling off, you're not taking care of your house, after a certain number of times, the bank could actually try to foreclose on you. It's because of the good repair clause. And then next year on 313, we get into transfer of mortgage here. So different types of mortgage assignments and mortgage takeovers. So normally, in most loans have an alienation clause that says when I sell the property, I have to pay off the entire balance in full. Now, if your loan does not have that, then you could assign your loan off to somebody else. Now, when you assign a loan off to somebody, it's done in one of 2 ways. Number 1, through what's called assumption, or number 2, what's called subject to mortgage. Now, both of these start off the same exact way. The buyer is going to pay the seller the equity in the property and then take over their loan payments. So again, number 1, the buyer is going to pay the seller the equity in the property and then take over loan payments. How do we calculate equity? Well, equity is as simple as this. Fair market value minus your loan amount, minus what you owe on it. So if fair market value, let's say, is $500,000 and my loan balance is $400,000, I have $100,000 in equity. So if I'm letting somebody take over my loan payments, they're going to pay me the equity, they're going to pay me the $100,000, and then take over my loan that has, let's say, a $400,000 balance with 27 years left on it at a 4% interest rate, for example, something like that. The big difference here, though, despite them starting off the same way, in the assumption of mortgage, the buyer is going to sign a promissory note. Now, by signing a promissory note, you've now made this debt personal to you. So if you take over a mortgage through what we call an assumption of mortgage, What winds up happening here is that you have created a personal obligation for yourself, the buyer, to repay the debt. So now in case of default, in the case of an assumption, the buyer is primarily liable for the repayment of debt. So if the buyer happens to default, since you assigned it to them, if that buyer defaults, the buyer is primarily liable. However, the seller remains secondarily liable unless a novation is signed. So the bank's going to say, listen, you could assign it off to John Smith, but you're secondarily liable. And you say, well, I don't want that secondary liability. Can we sign a novation? What a novation is, three-party agreement where one party seeks release from their liability. In this case, it would be the buyer, the seller, and the lender. And who wants nothing to do with this anymore? The seller. The seller is seeking release at this point in time. So you would do so through having a novation signed. And a novation, again, would be between the buyer, the seller, and the lender, releasing the seller from their liability. The other type of mortgage takeover, when you assign it off to somebody, is through what we call subject to mortgage. And the way a subject to mortgage works is I assign my mortgage off to John Smith, and he doesn't sign anything. He doesn't sign a promissory note. So in case of default, who's 100% liable? Me, the seller. I don't know, it'd be too much risk for me to take on personally, but it's an option. So the big difference between the assumption and subject to, and the assumption, the buyer signs a promissory note, making them primarily liable, and the subject to, the buyer doesn't sign anything. And being that the buyer doesn't sign anything, in the case of default, the seller is 100% liable in that case. So that's a big difference between the two there. Bottom right of 313, qualifying ratios. The number one to know about, we spoke about already, loan-to-value ratio. Make sure you know for value, it's always going to be the lower of the appraised value and sales price. So let's turn the page here. Let's go to 314. 314 on the right side here talks about Regulation Z. Now, just to briefly explain what Regulation Z is, it's basically a full disclosure after regulation. What it does, it requires lenders to fully disclose to you the true cost of borrowing money. So if a lender says to me, buy this home today, $2,000 a month, buy this home today, no money down, they have to disclose to me what that means, to a qualified borrower. Well, what is a qualified borrower? How much money do I have to put down? What's my debt-to-income ratio have to be? Loan-to-value ratio have to be? What's my credit score have to be? So on and so forth, things like that. So Regulation Z is a regulation that requires lenders to fully disclose the true cost of borrowing money. Now, there's some terms that can be advertised by themselves without full disclosure, one of which would be like general terms. So if we were to say, call today for a free consultation, if we were to say, call today to find out about our loan programs, call today, we have the best rates in town, call today, nobody will get your loan done quicker, things like that. Those are broad general terms, broad general solicitations. No disclosure is needed. But if we were to advertise things like, buy this home today, no money down, buy this home today, 4% interest rate, buy this home today, $2,000 a month, we would then have to provide full disclosure to qualified borrowers and what a qualified borrower happens to be. There's one number, though, that a lender is allowed to advertise by itself without full disclosure, and that's the APR. The APR is your annual percentage rate. So if they ask you what is the only number a lender may advertise by itself without full disclosure, that would be the APR, the annual percentage rate. All right, so moving on to the next page here, page 315, talks about PMI, private mortgage insurance. Now, typically, when you're taking that out is when you're putting down less than 20%. So if they were to ask on the test, if a borrower puts down less than 20% and the lender requires them to take out a certain type of insurance to protect in case of default, this type of insurance is called private mortgage insurance. So PMI, very commonly, if you put down less than 20%, you're paying PMI. Now, prepayment penalties on the bottom left here of 315. Two things to know for them. Number one, there's no prepayment penalties on residential loans. So no prepayment penalties on residential loans. There actually are prepayment penalties on commercial loans. So in other words, if I have a 10-year term on a commercial loan and I want to pay it off in full in 3 years, there will most likely be a prepayment penalty. Now, the lender's not required to charge you one, but they're allowed to. So there's no prepayment penalties in residential loans. They are allowed in commercial loans, though. And the next here on the bottom left of 315, we get into points. Now, points, sometimes referred to as discount points, basically a charge affiliated with the loan. Maybe it's because you're a riskier loan applicant, you have a low credit score, high debt-to-income ratio, things like that. How do we calculate points, though? Well, every point that they charge you is 1% of the loan amount. So to give you an example of that, let's say I take out a loan for $400,000 for a house that I'm buying for $500,000. Now, if they say you were charged 1 point, how much is that 1 point? That 1 point is $4,000, because points are 1% of loan amount. And every point they charge you is going to lower your interest rate by 1/8 of a percentage. So if my rate is 4% and I'm charged 1 point, my rate is now 3 7/8. So for every point they charge you, it's going to lower a borrower's interest rate by 1/8 of a percentage. And on the right side here at 315 talks about usury. So usury, that's an illegal interest. That's an interest that's in excess of legally allowable limits. So again, usury is an illegal interest. Another way of saying that is interest that is in excess of legally allowable limits. So just unfathomable interest. We don't have to know the rates necessarily, but just know that an illegal interest is described as usury. All right, so let's turn and go to page 316 here. On 316, we start getting into the different types of mortgages, and the first one listed here is an ARM, an adjustable rate mortgage. Now, in an ARM, as an example, they might say you have a 7-1 ARM. What does that mean? That means for the first 7 years, you're at a fixed rate of interest. And let's say today's current interest rates are 5%. Well, the first 7 years is going to be at let's say 4 1/4. It's going to be lower at what prevailing rates are today. But then, after 7 years, you hit the adjustment period. And then your rate adjusts based off where rates have gone. Rates have gone up, your rate's going to go up. Rates have gone down, your rate might go down. So with this ARM, as an example, if they say a 7/1 ARM, that means for the first 7 years, fixed rate of interest. After that, you hit the adjustment period, and that rate will then adjust based off where rates have gone. With that being said, one of the big concerns borrowers have here is what happens if rates skyrocket? I don't want my monthly payment to go from $2,000 to $3,000 a month. Well, the lender might say, okay, we're going to put rate caps and payment caps in place. That says your monthly rate will never go above this. Your monthly payment will never go above that, so on and so forth. Now, if they do that, and that rate cap or payment cap does get exceeded, you don't have to pay the additional amount that month. However, that additional amount does get tacked on to your principal balance and then starts compounding at, let's say 6% interest over the next 23 years or something like that. And that's what we call negative amortization. So if the rate cap or payment cap is exceeded, then what happens is what we call negative amortization in that case, where, basically, rather than paying down the loan, which you are, but there's money also being added onto the loan, which is going to compound, and at the end, you're probably going to have a balloon payment due. On the right side here of 316, talks about conventional loans. Now, conventional loans is a two-party transaction. If I walk into a bank and I take out a loan, that's a conventional transaction, right? So walk into a bank, take out a loan, conventional loan, two-party transaction, whereas we talk about FHA loans here on 317, FHA loans are three-party transactions, lender, borrower, and essentially what equates to an insurance company. So a lot of misconceptions about FHA loans. A lot of people think that FHA loans are only for first-time home buyers, and that's not true. Anybody can take out an FHA loan, whether it's your first home purchase or second home purchase, whatever home purchase for that matter. It just has to be for an owner-occupied house. Now, another misconception about the FHA is people think the FHA just runs around lending money. The FHA doesn't lend money. They insure loans. So I always tell people for test purposes, when you think about the FHA, think about a big insurance company, because the FHA's role is to insure loans. So what the FHA does is the FHA insures loans. So number one, the first thing to note for the FHA is number one, that they insure loans. Number two, the question usually becomes, well, if they're only insuring loans, who's lending money on them? And the answer is qualified lending institutions, which is really a fancy word for saying banks. Number three, do you have to have any money down? You do. You have to put some money down, at least 3.5%. You do have to have some money down. And number four, this is only for owner-occupied housing. You cannot use FHA loans for, me buying a 4-family that I'm not going to live in. So FHA loans are only for owner-occupied housing. And then if you turn the page here and go to page 318, talks about VA loans here. Now, with VA loans, a little bit different than FHA. VAs, only certain people qualify. To get a VA loan, you have to be a veteran. So VA loans are for veterans and their unremarried widowed spouses. So if they were to ask you who can qualify for a VA loan, keep it simple, a veteran can. Now, FHA loans were said to be insured. VA loans are said to be guaranteed, which is very similar. So if they say FHA loans are insured, VA loans are said to be, perhaps maybe the answer is guaranteed. The value of the VA loan is guaranteed, so if the veteran happens to default, there's protections in place there. Now, the two most unique things about VA loans, the two most unique things by far, is number one, it allows the borrower, in this case a veteran, to have the lowest down payment amount possible, and that amount is 0%. Under a VA loan, you can purchase a home with 0% down. That's number one. Number two, VA loans are capable of being assumed by both veterans and non-veterans. So if I'm a veteran, I bought a home under a VA loan. When I go to sell that home, I can allow anybody to assume that loan. I can allow veterans to assume that loan, a non-veteran to assume that loan, so on and so forth. So I can allow anybody to assume that. So the benefit of that to the veteran is that if rates have gone from where I took it out at 3.5% to 8% years down the road, I could sell this home and as a selling feature say, you can assume a loan from me at 3.5% interest that has 26 years left on it. And that might be very attractive and might cause somebody to pay a premium for that house. So VA loans are capable of being assumed by anybody, both veterans and non-veterans. But the thing is, if I'm a veteran and I allow somebody to assume my VA loan, I can't take out another VA loan until that one's paid off in full. You can only have one outstanding VA loan per time. So let's turn the page here. Let's go to page 320. So page 320 at the top left talks about CRV. It's bolded there, Certificate of Reasonable Value. Now the CRV is the VA's version of doing an appraisal. And one thing we should know for this is that when the VA does an appraisal, the FHA does an appraisal, whoever the hell does an appraisal really doesn't matter. Whoever does an appraisal, you as the borrower can always pay more than the appraised amount for a home. So if it appraised at $500, I could still buy it for $520. I would just have to increase my down payment though. They might say if the appraised amount comes out lower than the sales price, can the buyer go through the transaction? The answer is yes. You just have to increase your down payment. All right, and then on the bottom left of 320, it talks about mortgages classified by manner of repayment. So it talks about an amortized mortgage here. Now, the term amortization, the term amortized, what it means is the gradual paying down of both principal and interest, leaving a balance of 0 at the end. So if they were to say, which of the following best describes the gradual paying down of principal and interest, leaving a balance of 0 at the end, that's amortized. So if you take out like a regular 30-year fixed-rate mortgage, you're going to pay it back on an amortized schedule. But then we have partially amortized. So partially amortized is a loan that really leaves a balance at the end. So a number of examples of these, like one's a balloon mortgage. So let's say I take out a loan for $500,000, 10-year term, but a 30-year amortization schedule. That means this loan only has a 10-year term, but I'm paying it back if I borrow the money over 30 years. So after 10 years, I'm going to have a big lump sum balance due at that point in time. That big lump sum balance is going to be called a balloon payment in that circumstance. So in regards to this, the amortized, partially amortized. So partially amortized, realistically speaking, is any loan that leaves a balance at the end. So any loan that leaves a balance at the end is deemed to be partially amortized. And then, again, if they ask you about balloon payments, a balloon payment is a lump sum payment due at conclusion of a loan. So if we go to page 321 here, we now start getting into straighter term mortgages. Now, just so you know, they can use words like mortgage, note, and loan interchangeably on the test. We're just going to use the term mortgage here. So a straighter term mortgage is simply put an interest-only loan. So if they were to ask you which of the following best describes an interest-only loan, it's called a straighter term mortgage. So again, a straighter term mortgage best described as an interest-only loan. And then we have reverse mortgages. So with a reverse mortgage, what happens there? Well, with a reverse mortgage, number one, you got to be a certain age to qualify. You got to be 62 plus. But what's unique about this, it's the only type of loan in which a homeowner gets paid. So if they were to ask you, what is the only type of loan in which a homeowner gets paid? It's a reverse mortgage. Now, you have things like home equity loans where you get payments from, but this is a little bit different. So again, if they just ask you in the test, what's the only type of loan where the homeowner gets paid? It's a reverse mortgage. Then on the right side here of 321, talks about a purchase money mortgage. So in regards to a purchase money mortgage, this here is oftentimes used to describe seller-owner financing. So if they were to say, which of the following best describes seller-owner financing, it's a purchase money mortgage. Now, from a technicality standpoint, a purchase money mortgage could be used to describe any type of mortgage. It's the lender giving me purchase money in return for me signing mortgage documents over to them. So I think more often when you're going to see it is they're going to say, which of the following would best describe seller-owner financing? Purchase money mortgage would be your answer. But Just so you know, technically, a purchase money mortgage would be any type of mortgage. And then bottom right here of 321 talks about construction loans. So in regards to a construction loan is paid out in installments or draws. So if they were to ask you which of the following is, how is construction loans paid out, something like that, they're paid out in installments or draws, because when you're getting a construction loan, the lender wants to make sure you're doing the work you said you were going to do. Because if I take out a construction loan for $400,000 to build something on a lot that's worth $250,000, they gave me the $400,000 up front, I could run away, and their collateral to take would be a $250,000 property. They would lose a lot of money there. So they want to make sure I'm doing what I said I'm going to do. So they'll pay me out that money in installments as I get through each phase of the project. All right, so if you turn and go to page 322, we talk about bridge loans here on the left side. So a bridge loan is used for short-term or in-term, or what we call sometimes gap financing. What we mean by that is maybe perhaps you're buying an investment property that has 80% occupancy, and the lender says, we're not willing to give you permanent long-term debt, maybe 10, 12 years, unless you have 90% plus occupancy. So what we will do, though, is we'll give you a short-term bridge loan, maybe with a 2-year term, to see if in 2 years you get that occupancy up to 90% plus, so we can give you a 10-year loan as an example. So with this bridge loan here, bridge loans, if they were to ask about them, they're used for either short-term or in-term financing. So again, bridge loans used for either short-term or in-term financing. Then on the right side here at 322, talks about a blanket mortgage. Now, a blanket mortgage is used to cover several parcels of real estate. So if I'm a developer, hypothetically, and I want to build 100 units, I'm not going to take out 100 separate loans. I'm going to take out one big loan that covers all of them. We would call it a blanket mortgage. So a blanket mortgage is used to cover several parcels of real estate, and inside that blanket mortgage, you're going to have a release clause. What the release clause states is that as each individual property winds up getting sold, it is then released from the mortgage obligation. So we would call that a release clause, and that's found on the blanket mortgage. So let's say you took out a loan for $100, and you built 100 units, and each unit's allocated $1. As each unit is sold, you pay $1 back to the bank, as an example. And then we have package mortgages here. So as far as package mortgages are concerned, that is the financing of both real and personal property together as one. So if I buy the model unit in a townhouse complex, and I want them to leave all the furniture and all the decorations and stuff like that, and the value of that's $50,000, but all those models have sold for, let's say, $700, and I'm buying this for $750. Well, the bank, when they do their appraisal, they're appraising the real property value. They're not appraising like the furniture value and stuff like that. So the appraisal is going to come out at $700, because that's what all the comps, all the models, all the other units sold for that are similar to mine. So with that said, if we're going to finance the purchase of real and personal property together, you can do so through what's called a package mortgage. It's really rare, just so you know, but that's called a package mortgage. So that's the financing of real and personal property together as one. Then bottom left here at 323 talks about primary versus secondary mortgage market. So in the primary mortgage market, that's where you have loan origination. If I walk into a bank and they lend me money, that's a primary market activity. After they lend me the money, if they were to turn around, and when they turn around, they sell off that loan to an investor. At that point in time, the person who they're selling that off to, that's a secondary market activity, that investor. That's on the secondary markets where loans get bought and sold over and over and over again. Primary market, lender lends money to a borrower. On the secondary market, loans just get bought and sold over and over and over again. So that's an example of that. And, some of the big players in the secondary market you've probably heard of, Fannie Mae, Freddie Mac, things like that. So Fannie Mae is privately owned, government sponsored, and they buy and sell mortgages in the secondary market. Fannie Mae is like a publicly traded company, so anybody can invest in Fannie Mae. And if we skip ahead to the right side of 325, talks about land contracts here. And land contracts, we go over these to more or less explain to you that they're not the same as a trust deed. They have similarities, but they're not the same thing. So in a land contract, the seller does take back a note as part of the purchase price. So for example, the buyer offers me $500,000 and says they're going to put $200 up front, but they want me to hold a note for them for $300 that they'll pay back at 5% interest over 10 years. Under a land contract, me as a seller, when I accept that offer and I sell the home, I actually hold on to the deed. I hold on to the deed to the home until the buyer pays me either a stated portion or entire balance of that loan back. So that's the big difference there. So under a land contract, the seller holds on to a deed until the buyer pays either a stated portion or entire balance of the loan. All right, and if we turn the page here and go to page 326, bottom left here talks about a sale-leaseback. So in regards to a sale-leaseback, probably one of the more common questions you'll get about this is who becomes a tenant. And if you just read the word and the phrase, you'll know who becomes a tenant. So I'm selling it and then leasing it back. So in a sale-leaseback, the seller becomes a tenant. Again, I'm selling it and then leasing it back. And then we get into illegal discrimination and lending practices. So the first one here is the Equal Credit Opportunity Act. So in regards to the Equal Credit Opportunity Act, they might ask you, what does this, imply? What does this talk about? So in the Equal Credit Opportunity Act, basically what happens here, it's them saying to you, you cannot discriminate when lending money. So, for instance, a lender cannot discriminate on the basis of race, creed, color, sex, national origin, you name it. They have to treat you objectively, treat you based off your numbers. So, again, the Equal Credit Opportunity Act just says you can't, lenders can't discriminate when lending money. Redlining here. So, if they were to ask about redlining, imagine a lender drawing a red liner in a certain area, saying a lot of minorities here. I'm now going to issue far fewer loans. Is that legal or illegal? Well, obviously we can indicate that that's illegal. The common sense would indicate that to you. But how would anybody ever find out that this is even going on? Well, number one, a number of people would file complaints, right? Number two, though, how do they prove that it's discriminatory? Well, there's this act in place called the Home Mortgage Disclosure Act. And the whole purpose of this act is to require lenders to fully disclose all loans you're both approving and denying. Because if you're disclosing all loans you're approving and denying, we see a big discrepancy where in areas of high minority populations, very similar, if not identical applicants are getting denied, whereas if those same applicants apply for the same price in a different area that has less minorities are getting approved, we have a pretty clear showing here that redlining is going on. So the act in place that prevents redlining, that's written in there, is called the Home Mortgage Disclosure Act there. And then on 327 here, give some examples of mortgage fraud. These examples will slap you on the face on the test. They should be very obvious. So, like falsifying employment income, I apply for a loan and say I make $100,000 a year, I make $50,000 a year. If I apply for a loan and I say I work for XYZ Corporation, when in fact I work for ABC Corporation, or I don't have a job at all, that's employment fraud. I just talked about, income fraud. So in other words, if you're falsifying your income, that's another one. Occupancy fraud, if I apply for a loan and say I'm going to live there and I don't live there, occupancy fraud. Identity theft, if I apply for a loan as John Smith, my name is Jane Doe. Identity theft, again, as I said, these things are all pretty much common sense here. And then on the top right there, it talks about a silent second mortgage. So in case they do ask about this, you can have a second mortgage, that's okay. You can't have a silent second mortgage. So to give you an example of that, if I happen to apply for a loan, and I apply for a loan with a bank, and I say I'm buying a house for $500,000, I need a $400,000 loan. I'm putting $100,000 down. Bank says, okay, you're qualified, you're good. Now, I actually don't wind up putting $100,000 down. What I wind up doing is I tell the seller, hey, hold a note for me for $100. I'll pay you back that $100 at 5% interest over the next, 10 years. If I don't inform the bank about that, that is what we call a silent second mortgage, and that's illegal. That's not allowed. And that there pretty much does it for Chapter 14, the mortgage chapter. So one of our longer chapters in the book, one of the more challenging chapters, one of the chapters where you'll certainly get a good chunk on the state and school exam. So as always, if you guys have any questions about this chapter, any of this content, feel free to email me. This video, again, is purpose of it is to serve as a brief rundown, brief recap when you guys are studying for the test. So again, my email is kylekovats@gmail.com. We'll talk to you guys soon.